Welcome back. You're watching us here on Trading Hour. Let's welcome Murtuza Arsiwalla, who's a real estate analyst from Kotak Institutional Equities, joining us from the sidelines of the Kotak Institutional Equities Chasing Growth Conference 2026. Murtuza, always a pleasure speaking with you. What's your call on the real estate space? Just got to ask you this, largely because on the one hand, stocks haven't done much all of last year after having seen a big surge in the previous year. There have been price increases. There has been demand, in a lot of pockets which are improving, but then there are a lot of players in a lot of pockets which are facing demand slowdown as well. So amidst this uncertainty and multitude of cues coming in, what is your call, and what are some of the stocks that you like? What are some of the stocks that you don't like?
Sure. Thank you so much. Hard. No one has a crystal ball to tell how the demand goes, but it's a pretty sort of one-sided street where the view is that the industry volumes are moderating, and therefore even if companies are reporting good numbers, it's only a matter of time before their sales falter. Now that view, essentially, if I look at some of the larger companies within the residential space, they are still able to meet their full year guidance. And mind you, if I look at the aggregate of my coverage universe, you're looking at double-digit growth in sales. Even going into FY26, we will start seeing the guidances for the next year when the fourth quarter results come in. But at a company level, performance still good. Industry may be a bit stagnating. Almost all players have talked about approvals being an impediment to new launches, and launches are important in terms of getting sales. Investors arguing whether the lack of approvals or launches is sort of a cover-up for not having adequate demand on the ground. I think in due course time will tell. What is true is that companies continue to deliver good numbers over the last almost 6 to 7 quarters versus industry volumes which have been more stagnant. Now you could, in that scenario, given where stocks are, you make for a very attractive proposition. DLF, Brigade amongst the larger pack clearly stand out. And the irony of this is that in such an environment, the street is not even differentiating between the subcomponent of earnings. The names that I pulled out, DLF, Brigade, have a reasonable amount of annuity earnings, which the street likes when you look at the trading multiples of the various REITs, which have done extremely well. But on this hand, where when you look at a DLF or a Brigade, they're really painting the entire earnings profile or cash flow profile with the same brush. We remain constructive. DLF and Brigade stand out as amongst our topics.
Murtuza, thank you for joining in. Where the concern right now for real estate may not necessarily be industry dynamics per se. It also maybe has a lot to do with what has been transpiring across the globe, with a lot of this AI-related concerns that have led to a very, very sharp sell-off across the entire IT basket. And would that somehow turn out to be a bit of a proxy concern, because the stocks in the real estate space as well are down anywhere between 5, 10, 15% already this year?
Absolutely. So again, discussions which keep coming up, you're not going to run too far before you run into a discussion on AI. There are concerns. A lot of the developers do have a large presence in Bangalore. But let me give you another flip side to it. When I look at commercial real estate, you're clocking 14 million square feet of quarterly leasing this quarter, which is fantastic. On a 9-month basis, you've done 40 million. If companies are taking up so much space, there are obviously more jobs being created. It may be on the IT side where the hiring trends are not as encouraging. But on the flip side, there are GCCs which continue to come in, take up new space. So when I look at the office market, from a real estate angle, I'm seeing record leasing levels, which means jobs are still being created. Hard to call what the future holds in store with, the technology disruptions, etc. But for now, the numbers continue to sustain. Yes, the street's concerned of real estate being, a second-order impact of what could happen in the technology sector.
fair to assume then, Murtuza, based on what you also mentioned, jobs may be created, yes, but this residential upcycle, we'll get to commercial real estate in just a bit, but just to round off the loop on residential real estate, is the upcycle now entering its final legs, and before we hit a period of saturation and then again you move towards a bit of a down cycle before the revival starts again?
So let's look at it this way. The upcycle really started post-COVID. The first 3 years, you had strong double-digit volume growth. And it's almost been 2 years. I'd say, the best was probably 2 years ago. And you've had 2 years of near stagnant volumes at an industry level. So you're well in that consolidation phase or stagnation phase, 2 years already. We don't have a very long history of data. We really got it from 2007, so we don't have an extremely long history. But if we were to go by that, the previous ups and downs and stagnant cycles, you had an upcycle which lasted the previous time about 3 to 4 years, which is not very different from this time. And then you had maybe a 5-6 year period where sales were sort of stagnant. You've been more than 2 years into that phase already, as you look back. So, yeah, hard call, but maybe the best is behind us as far as the sector goes. Companies could continue to do well.
So, in that case, if one had to look at any attractive opportunities right now, should they even look at the real estate space?
Well, that's a question that often gets asked. But if you look at the valuations of companies, they're pretty much, given where stock performance has been, they're factoring in near no growth, where the sales have been fairly resilient, healthy sales numbers, valuations extremely attractive. I mean, the stocks are pricing in near no growth in sales, which is what the base case assumption is. Should the company surprise you, that's when you make money.
So very quickly, Murtuza, if you could tell us, between residential and commercial, where would your preference lie? You would choose the REITs and the InvITs and so on as a better investment opportunity, or would you still go with the larger residential players like the Godrej's and the DLFs?
Well, look at it this way. That's the point that I was making. There is a DLF which has a larger annuity portfolio than any of the REITs, and it's trading very low on valuation multiples. So you've got this mix between residential and commercial when you look at some of the players which have sort of a mixed sort of business dynamics. As far as REITs go, I think the industry performance is great and the market's sort of pricing that in. And ironically, while the risk of AI, etc., seems to be substantially being priced in residential real estate, but no one seems to be talking about it or not seem to be priced in as far as commercial real estate goes. Our view on REITs, you could still make reasonable money, not the kind of returns that you made maybe in the last 2 years or so, but still can make a reasonable return. You're looking at dividend distribution yields which are more around the 6%, earnings growth which is still in double digit, so you could make reasonable return. Deep value really lies in the residential piece, because if you're sort of looking at that investment, you're really taking a contrarian view versus the street, where the street almost stands unanimous that the best of the cycle is behind us.
Murtuza, pleasure having you today. Thank you so much for sparing time and joining us. Look forward to having you more often on this very insightful conversation on the real estate space. By the